So moving on to underinsurance and what is underinsurance. In simple terms, it's when a policyholder has inadequate insurance cover for their needs. What generally happens then, if there's a loss, it results in a potentially serious financial loss for the organisation. So it's a key thing in getting right. Typical areas of insurance, which we see again with manufacturing and wider clients, property, stock and contents, plant and equipment, and their business interruption. And in terms of the effects of underinsurance, there's a long-standing insurance clause called average, which means that if you are underinsured, then any claim would be also underpaid by whatever percentage you are underinsured by. So in the case of large claims, it's massively, massively important that we get these figures right from the outset and they're regularly reviewed. So what are the key things that can lead to being underinsured? Valuations being out of date. If you've had your building valued 5 years ago, that might have been what the valuation was then, but certainly with the increase in materials, it probably bears no resemblance to what the rebuild cost is now. So it's vitally important you get those regularly reviewed. We often see as well there are sort of standard policy limits within policies which policyholders aren't aware of, and they mean that there's a certain level of underinsurance. But we also see that some clients decide to underinsure and not declare the correct sums insured to get cheaper premiums. But at the end of the day, if you do that, it's only going to end up costing you more money if a claim did arise. So common pitfalls, as alluded to on an earlier slide there. So in terms of property, as I mentioned, out-of-date valuations is the key one. So making sure that that's updated, if not annually, every 2 years, getting a professional buildings valuation surveyor in to do that. Change of use as well. We've seen a lot with a lot of our clients over the sort of pandemic period that they've started undertaking slightly different activities within the business, and whether these have been declared to their broker or discussed with their broker, or whether the broker's interrogating them to understand exactly what they're doing. But again, if the business has changed slightly and that's not being declared, then you could find that you're underinsured. Another important consideration on the property side of things is a lot of clients we see insure the building on the market value as opposed to what it would cost to reinstate it. So reinstatement cost is the cost of obviously bricks and mortar or equivalent building materials, but it's also taking into account things like site clearance, debris removal. So when you're setting your building sum insured, it's important to do it on a reinstatement basis as opposed to what the market value is. From a stock and contents perspective, the most important thing to remember here is that any replacement will always be on a new for old basis. So whether you've got a 30-year-old machine that you might find difficult to replace, well, you wouldn't be able to replace, you've got to bear in mind what it would cost to replace the modern day equivalent, in effect. So what that would cost. So if the machine cost 25 grand 20 years ago, but now is more like £100,000, you've got to make sure that that sum insured is reflective of that. We've also seen, again, over the last 18, 24 months, a lot of our manufacturing clients have increased their stock holdings due to ongoing supply chain issues. But again, that's not necessarily been declared or discussed with the broker. So it's vitally important, again, if you do decide to increase your stock holding because of those supply chain issues or for whatever reason, that this is reflected in your insurance program. From a plant and machinery perspective, similarly to stock and contents, new for old basis, so it's important to take that into account. And then if you've got any specialist equipment as well, it's important to think about timescales to replace those. And this moves on to business interruption. Core things there, indemnity period. So that is the period of time an insurer will pay out for your loss of profits whilst the business is unable to trade. So we're more than often see under insufficient limits of 12, 18 months, where realistically, certainly in the current state, if there's a total loss of a building, it's going to take more than 18 months to get that site cleared and get the building re-erected. So We urge most of our manufacturing clients, especially larger sites, to consider a minimum of 36 months. So it's just another area to give some consideration to. On the business interruption side as well, the gross profit calculation is a key one, and often an area where we see clients fall down and become underinsured. So the gross profit calculation under your business interruption is different to that of your accountancy one. So it's a conversation you should be having with your broker, and they are giving you some guidance around how you calculate your gross profit for insurance purposes. Another key area is that we don't often see being discussed with broker and client is the business continuity plan. So many businesses overlook this, but this is essential. Gives you a way of identifying potential risks and how you'd react to them. So it ties in well with business interruption and risk management. And that's certainly an area Gallagher sort of manage really closely with their clients and can support with.